Friends, welcome back to our channel OMSAI Bhojanapalli.
Stop talking. Stop talking, please. Shh. Those who are not copied, raise your hand. Fast, please. Shall I start or not? Now, please. Shh. Let's start our discussion. See, let us have a discussion about a concept called as short selling. This is very important even in derivatives chapter, where call option and all derives value only through this concept called as short selling. Let us understand what do you mean by short selling, how it works, and then come back to this particular problem and then discuss more about the APT. Please. Shh. Now, let's take two examples. Mr. X finds or believes that the share market is going to be bullish. The share market is going to be what? Bullish. Bullish means price is going to increase. Bearish means the price is going to decrease. Different person may have different anticipations or what? Expectations. Now, he believes that the share market is bullish. Tell me the strategy for him. Today you should go and buy the share, sell the share, buy the share. Now tomorrow price is going to increase means the strategy to make profit is what? Buy the share today and sell when the price what? Increases and make a profit. Is a normal strategy one follows. Respond yes or no? So in case of a bullish market, you buy and sell. It is what? Buy at a lower price today and sell tomorrow at what? A higher price. Respond yes or no? Now, suppose I believe that the market is going to be bearish. The market is going to be what? Bearish. Let's say security C I'm having. I'm having what? Security C. What I will do in case of a bearish market, if I'm holder of a security, what I will do? I'll sell my security which I'm having now at suppose 100 rupees. Later when the market drops to what? 80 rupees. I buy back the security and make a profit of 20 rupees. Yes or no? In case of a bearish market, I'll first sell the security and then what? Buy the security later. Everybody following or not? I'm just giving an example. Okay. So bullish market, the strategy is what? Buy and sell, and bearish strategy is going to be what? Sell and buy. Yes or no? Okay. Now, sell and buy, if we say, I am believing that security C price is going to decrease. What is going to decrease? Security C price is going to decrease. So what I should do? Sell today security C and buy tomorrow what? Security C. Respond yes or no? But I don't have security C now. That's what I am saying. Suppose I am knowing that security C price is going to follow. And I am watching the newspapers. I believe that today security C is trading at 100 rupees. Tomorrow it will be falling at what? Falling at what? 80 rupees. I surely know or I believe that the price of the C is going to what? Fall. Okay. In that case, I don't have C. I don't have what? Security C. Can I sell it? Do you understand my question or not? Now, if I have the security C today, I sell the C at what? 100 rupees and buy in the future at what? 80 rupees, make a 20 rupees profit, right or not? But the question is, I know that the price is falling, but I don't have the security to sell. Yes or no? In that case, tell me, can I sell today, buy tomorrow? Yes. It is possible. That is what we call as what? Short selling. Okay. Now, this is possible in the share market, but not in what? Any other market. I just a simple example here. Now, I know that your house price is increasing. Suppose having a house property, okay, I know that your house price is what? Increasing. Can I sell your house today? And then later buy from you tomorrow? In a transfer of property act will not allow person not being a owner to want to sell it. In my son, no, I cannot sell it. I said I have sold your land today. Give me the land what tomorrow. I cannot do it. So because always first to buy and then what sell. That's a normal business transaction. I should be owning for an asset to be what sold. So first to buy and then what sell is happening in all the markets. Yes or no? But in share market, even without owning a share, even what? Without owning a share, I can sell the share and then buy it tomorrow. Or you know what I'm saying? This process of selling a share without owning it, which I call a short sell. We call as what? A short sell. Some countries permit and some countries may not permit. Some countries permit in intraday transaction, which I don't really call as a short sell. Some countries permit for what? 15 days or 1 month and so on. How long you can be taking a short position? It depends on the laws of country to country. We are not discussing country specific subject. We are discussing what? Global subject. So short selling is a concept. Everybody, are you following what I am saying? So tell me, what do you mean by short selling? Selling asset without what? Having it, and then what? Buying it later. We call it short selling. Everybody, are you following or not? Let's understand how it works so that we can understand APT much more easily. Okay, how the short selling works. See, there are 4 parties involved generally if you want to do the short selling. There is Mr. X. He is the person who is going to do the short selling, or we are Mr. X. You understand or not? That is Mr. X. There is his broker, BR. There is a broker called as what? BR. Okay. There is a lender called as L. There is a buyer called as B. These are the 4 persons. Okay. X is a person who is going to sell the share. He is going to sell the share through what? A stock broker. There is a lender. I'll tell you who he is. And there's going to be a buyer of the share. Okay. Now, see. X watches the share market closely. He believes that security prices are showing a declining trend. It will be decreasing for a near future. This is what X is believing. Everybody, yes or no? No. In that case, X want to sell the share C. Want to sell what security? C. Is he having security C or not having or not having? Then he says to the broker that, please sell for me security C. He gives what? A sell order to the broker saying that please what? Sell for me the security C. Are you following what I am saying? Now, the broker says, please transfer the shares to the demat account of the buyer. So please give me the demat account number, etc. You said that no, I don't have any share. I have to only buy it later. So I don't have share. Sell the share for me. I'll give the share later. This is what you tell the broker. Everybody yes or no? The broker says, okay, no problem, I'll do it. So what happens is, broker borrows the share from a lender of a share. He borrows money or shares or shares. I asked 100 shares of security to be sold means he borrows how many shares? 100 shares. If a person is going to lend the shares, how banks give money, like that people also give what? Shares on loan. So the lender is giving what? Shares on loan to the broker for some period. Somebody lending for how many months here? 3 months. So the lender says, I'll give the share for 3 months. Return me the share after what? 3 months. Is what the lender says the broker. Everybody following what I'm saying? Now, what the broker does is, he gets the share from what? Lender, and he sells the shares to what? The buyer. He sells the shares to what? Buyer. Make delivery of the shares to buyer. Yes or no? No. And the buyer gives the money or not? He gives to what person here? X. He is only selling the share or not? So, very simple. I am X. I want to sell how many shares of security C? 100 shares of security C. I am having the share or not having the share or not having the share. Still I give a sell order to what? Broker. Broker says, no problem, I'll sell it for you. He borrows the 100 shares from a person called as lender, and the share is delivered to what? The buyer. The buyer gives the money. The money is given to what? X. This is the transaction 1. Everybody, yes or no? Now tell me, who is the owner of the share? X is the sold here. How can it be owner? Who is the owner of the share here? That is, B is also owner. L is also owner. Both are what? Owner of the share. Okay. B is the owner as per the company records. L is what? Lend the shares. Everybody has on the situation. Can I say? Now, what happens is, within 3 months, on any day, or not later than what? 3 months. Suppose exactly at the end of third month, what the X does here? He goes to the share market. He goes to what? Share market. He purchases the share. Now the share may be trading at 100. That may be trading at how much rupees here? 80 rupees. He pays money and purchases the share at how much rupees here? 80 rupees. Once he buys the share, can he keep it or not? No. He transfers it to the demat account of what? Broker. The broker gives it to what? Lender. The short position is squared off or what? Close. Is what generally the short sale happens. Everybody, are you following what I am saying? No. So again I say, X is a person not having shares, but he sold what? Shares of C Limited by using a broker. What the broker does? He borrows and makes the delivery. And after some time, yes, goes to the share market, purchases the shares and returns it back to the broker who gives it to what? Lender of the share. This is what we call as a short sale or short position. Everybody, yes or no? No. In that case, you may ask who may be a lender of a share? Who may be what? Lender of the share. There are investment banks with having so many shares invested as what? Collateral. Okay. This can be one of their business is what? Lending the share and earning some commission on that. Everybody follow what I am saying? And as X may feel that his gain is going to be what? More than the commission paid, and he may be able to what? Make a arbitrage out of it. Everybody, are you following what I am saying? So a lender of the share can be many person. Even broker can himself act as what? A lender of the share. He may also have a portfolio of shares or not. But something is borrowed and then what? Delivered. Everybody, can I possess or not? No. Two things can happen in between the 3 months. Let us see what are those things. Okay. First of all, in the second month, company declares a dividend. Company declares what? Dividend investment there, second month. My question is, company pays dividend to X, L, B. Because as per company record, in the register of deposit, who is having this number? Say share here? B. B will be getting the dividend from the company. Yes or no? But who is also entitled to dividend? L. He has not sold the share. Still it is his share only. So no. L says, I also want dividend. Company declares 10 rupees dividend. Yeah. B will be getting it. L says, I also want what? Dividend. In that case, who should give the dividend? X should give the dividend to L through the broker. Everybody yes or no? You may ask why X should give the dividend? Because X has sold the share at come dividend price. Today he sold, dividend will be declared after what? 2 months. When he sold the share today, the share selling price is loaded with dividend or not? Yes. Since X is receiving what? A come dividend price, it is a duty of X to pay what? Any income coming from that asset during the short selling period to what? The lender of the share. Is the next point one should be understanding it. Yes or no? This I'll be dealing once again in the option valuation later. Everybody following or not? So this is point number 2. Last. Sometimes the agreement may say that maximum 3 months. But the lender may have a right to ask for the share anytime. Like the agreement may be what? Draft up. In that case, lender gave the share today. In another 10 days, he says, I want the share back. He started crying. Okay, in that case, what X has to do? He has to go to the market, buy and deliver, irrespective of the price increasing or what? Decreasing. In that case, his position is said to be short squeezed. It should be what? Short squeezed, where the lender is what? Pressurizing him to want to return the share earlier. It may be possible in an agreement of that particular type. Everybody following not? So this is overall idea about the concept called short selling. While we are discussing in APT, will be the next area of discussion. Everybody following or not? Now, very simple. What is short selling? Borrowing share and selling it. Then what? Later buying the share and returning it back. That's all. So no, to put it simply, what is short selling? Borrowing the share and then what? Selling it today and later what? Buying the share and returning back the share is what we call as what? Short selling, and we can make a profit in between. Everybody accept or not? No. That can have a small commission or brokerage which we normally ignore in the say portfolio theories, because in portfolio theories, brokerage, transaction cost, everything will be what? Ignored. So don't or say rake that particular point while discussing the theory. Can you proceed or not? Now, let's come back to this particular sum. Answer my question. I have how much rupees in my hand? 1 lakh rupees. I want to invest how much rupees? 2 lakh 50. I have only 1 lakh. I want to invest what? 2 lakh 50. Forget about any other thing. Normally, what you will do? Borrow 1 lakh 50 and then invest. I have 1 lakh rupees in my hand, but I want to invest how much, sir? 2 lakh 50. CML extended, we discussed earlier, yes or no? So I have 1 lakh in my hand. I want to invest how much? 1 lakh 50. I want to invest 2 lakh 50. How to invest 2 lakh 50? With only 1 lakh in my hand. Borrow 1 lakh 50 and then want to invest. Respond yes or no? Okay. Now, this is one strategy. Other strategy is, instead of borrowing money from the bank, instead of what? Borrowing money from the share, borrow share and invest. What I'm saying? The two types of borrowing, borrow money, other option is what? Borrow share. I can borrow share, sell the share, raise the money and then invest. There is another possibility that, yes or no? Now, APT says that the two types of borrowing that can exist, one is what? Borrowing money, another is what? Borrowing shares. Yes or no? Now, if I borrow shares, that is what I call as short selling. What is short selling? Borrowing share. What I call as what? Short selling. I borrow security C and then what? Sell it for how much rupees? 1,50,000. With that money and already 1 lakh in my hand, I invest or not. So I take another borrowing route. Instead of borrowing money, I am going to borrow what? A share. This APT is a very interesting prospect. Are you following what I am saying? Now I'll say why borrowing share is better than borrowing money. Let us go for that particular discussion. Can I proceed or not? Now, see. When I borrow money, suppose the C is not share, the C is what? RF. The C is what? RF. I borrow 1,50,000. I borrow how much base? 1,50,000. This minus 1.5 stays. But what is the beta of borrowing? 0. What is the beta of borrowing? 0. That makes my portfolio risky. Are you following or not? Now, I'll say why it is later. Now, very simple. Instead of this 2, I'll be having what? 0. Now, what is beta of risk-free asset? 0. So, what is beta of borrowing? 0. That means whether share market increases or decreases, I have to pay what? Same interest. So, in that case, the borrowing beta will be what? 0. Our minus 1.5 proportion into what? 0. What is weighted beta? 1? 0. What a portfolio beta? 3 times. In my son, no? Understood? Now, portfolio 2 also, the beta is what? 0. So what is weighted beta 2? Minus, that is, it becomes what? 0. It becomes 1.5. Yes or no? Now, instead of having a risky and riskless portfolio, the portfolio becomes what? 3 times or 1.5 times riskier than the say, macroeconomic factor. Everybody, yes or no? But instead of borrowing 1,50,000, if I want short sell for 1,50,000, I can make the portfolio riskless. Yes or no? This is the next issue which I want to discuss. Why borrowing share reduces risk, why borrowing money increases risk is the next issue to be discussed. Everybody, are you following what I am saying? Now, let's go for the discussion. Now, see. For example, what is beta 1 for security C? Solopa. Paathu sollu. First of all, those are awake, raise your hand. Are you following now? Please. Do you understand what I am saying? Can I switch on the AC? Forget everything. Now, I am finding very difficult to teach the batch here. Okay, no expression, no reaction. Please, listen here, please. Simple here. I have 1 rupee, correct? I have 1 lakh rupee, right or not? I want to invest how much? I want 2,50,000 to invest. I have only how much base here? 1 lakh. Can I print to 1,50,000 note to invest? That's illegal, yeah, correct? Now, can I smuggle notes, print notes here? Not possible, yeah. Now, I have to raise 1,50,000 finance, correct? I have to borrow 1,50,000 or not? I can get that 1,50,000, borrow 1,50,000 in 2 ways. I can go to the bank, apply for a loan and get 1,50,000, yes or no? Yes, sir. Correct? This is called as what? Borrowing 1,50,000. Or I can also borrow what? Security C. I go to the broker and say, please borrow share and sell for me. Please borrow share and what? Sell for me. So the broker borrows what? Share C and sells for me and give me 1,50,000. Yes or no? Now, in one case, bank gives 1,50,000. In other case, what? The broker gives me what? As loan, share, which I sell and get what? 1,50,000. In both cases, 1,50,000 is borrowed. Yes or no? One where I borrow 1,50,000 as cash, another I borrow 1,50,000 as what? As share. That's the only difference. Yes or no? Point number one. Point number two. If I borrow in cash, if I borrow in what? Cash, in that case, I have to pay the same interest every time. Yes or no? In such a case, what is going to happen is the beta of cash is going to be what? 0. Accepted? Now, in such a case, what is going to happen? The portfolio beta will be 0. What increases? Increases. So when I borrow and invest, the risk increases. So no. But at the same time, if I invest through what? Short selling, the risk is not going to increase. It's not know what I'm saying. Why it is, it will be the next stage of discussion. Are you following my discussion or not? Now, look at this. If you look at the slide, I asked the question, then only I got disheartened. What is factor 1 beta for security C? Is how much here? How many times here? 2 times. The meaning is very simple. If factor 1, let us assume as GDP, it is what? GDP. Okay, that's an assumption. If the GDP increases by 1%, grows up by what? 1%, my share return goes up by how much percent? 2%. If the GDP drops by 1%, the share return also how much percentage? 2%. Is what is the meaning of the 2 times factor 1 beta? Yes or no? No. I'll say the beta 1 is nothing but what? GDP. Can I push it up? Now, look at this. 2 things. One is GDP increases by 1%. What happens here? Share price increases by 2%. Now beta positive or negative? Positive. Same direction. Next is what? GDP decreases by 1%. What happened? Share price decreases by 2%. Everybody, are you following or not? No. As an investor in the, suppose I buy security C. I buy what? Security C. When GDP increases, I am happy or unhappy? I am a purchaser of a security C. Suppose I am investing in security C today and tell me when the GDP increases, I am happy or not? Yes. When GDP increases, my share price what? Increases. I can sell at a higher price, book a profit. Yes or no? When the GDP decreases, I am happy and unhappy because when the GDP decreases, the share price decreases. Today I bought at a higher price, I have to sell at what? Lower price. I have to book a loss. Now, are you following what I am saying? That means, as an investor of a share, a person taking investment position is very happy when the GDP increases. Unhappy when GDP what? Decreases. He is positively correlated to the GDP change. Yes or no? His beta is positive. His beta is what? Positive. Now, same person is not buying the share today, he is what? Selling the share today. You take a position which is not a buy, we take what? A sell position. Yes or no? No. The beta of the share to the GDP may be 2 times, but the beta of the share to GDP, when you take a sell portion, can become what? -2. You know what I am saying? Because when the GDP increases, the share price what? Increases. As a short seller of shares, you are happy about increase in price, unhappy. Because today you say sold at what? Some price. The price increases tomorrow. I have to buy at what? Higher price. I will be making a loss. So no. So when GDP increases, I am going to suffer what? Loss in return. When the GDP decreases, I am happy, unhappy. Happy because the share price decreases. I can buy the share back at what? Lower price and make a profit. Yes or no? So the factor positive beta 2 can be converted into what? Negative beta by taking an opposite position in the market. Yes or no? Beta can be positive for the factor in the share, but the same beta I can make it as what? Negative for me by taking a short position. Respond. Yes or no? What is a negative factor beta? I can convert it into what? A positive factor beta. Again, we take a start portion for that particular share. Yes or no? For example, security B, we have factor 1 beta as -1. Yes or no? Suppose I want to make it as plus 1. I want to make it as what? Plus 1. How to do? Yeah. Take a short portion. It becomes what? A plus 1. Everybody yes or no? So, a beta can be negative as it is. Factor beta can be negative what? As it is. Or I can make a factor beta negative by taking what? A short portion. Both they can play in the market. Respond yes or no? That means, understand that when I construct a portfolio with positives and negative beta, I can in fact make my portfolio risk-free. On one hand, I am happy, another hand, I am unhappy. In that case, the portfolio can be made risk-free. Come to this particular example. See, security C is having a beta of 2 times. If I invest, then I am having what? A positive beta, right or not? But since I am doing a short selling, this 2 beta, that is, it is 2 beta for a minus 1.5% becomes what? Minus 3 beta. Respond yes or no? Now, see, by investing in security A, my weighted beta is 3.5. How I tackle the 3.5 risk? How I tackle the factor on suppose GDP? What factor on here? GDP. When the GDP goes up by 1%, due to security holding, my return goes up by how much? 3.5%. When the GDP drops by 1%, the security makes me want to lose 3.5%. Yes or no? That means I am having a 3.5 beta due to security A. Yes or no? I want to make my risk 0. Whatever may happen to GDP, my portfolio is not going to change. I want to have that particular confirmation. Yes or no? In that case, the 3.5 positive beta should be countered by injecting negative beta. Yes or no? I have 2 ways of having negative beta. Select that portfolio, select that security is having a negative factor beta itself. Are you following what I am saying? Correct? Now, some case, banking sector may be having a positive income through interest rate increase. When interest rate increases, banking sector may have what? Positive beta. Others may have what? Negative beta. Are you following what I am saying? So, to target the positive beta, I should inject into the portfolio what? Negative beta. I have 2 options for putting negative beta. Either select a security which is having what? Negative factor beta, or take what? A positive factor beta security and take a short position. Everybody yes or no? These are the 2 ways in which I can negate my risk. Yes or no? This is a very famous strategy followed by most of the hedge funds. Are you following what I am saying? In that case, I have 2 options to make my beta less. How to reduce the risk? Either take a position in the security having what? Negative beta to counter the positive beta, or take what? An opposite sell position so that the positive beta can be converted into what? Negative. That makes it 0. Everybody yes or no? Now, let me proceed further. See. In this case, there are 2 things. 1,50,000 rupees, I want money. One option is I can borrow and invest. If I borrow and invest, that cannot reduce my portfolio risk. Yes or no? But if a short sell invest, it is always having what? A reduction in portfolio risk, because always short selling. I am investing in one share, I am selling in what? Another share. Now, when market performs well, investment gives me return and the selling gives me what? A loss. The portfolio remains stable. Yes or no? In other case, if the investment gives you what? Loss. Market crashes. Investment gives you what? Loss. The short selling can give you what? Gain. What happens? The profit remains what? Stable. So, if I borrow, whether the market goes up or comes down, I have to pay what? Same interest. Yes or no? When I have to pay what? Same interest. The problem is, when the market crashes, still be having what? Same interest. There's a financial leverage created. Yes or no? Here the leverage is not created because the borrowing is variable borrowing. Yes or no? The borrowing itself is what? A variable borrowing. In that case, when the market performs, then one investment will give me the return and the short sell will give me what? Negative return, and vice versa. In that case, the portfolio can be made stable through short selling. Everybody, yes or no? So, APD says that by bringing into portfolio not only RF and then investment, that is what Markovitch said, that is what CML, everybody said only about what? RF and then what? Investment. He also brings in the picture of what? A short selling concept also, everybody following not. So with the help of short selling, I need not even go to what? Bond market or loan market, and just do everything in what? Share market itself through what? Short selling, investing, etc., and consider a risk-free portfolio. Everybody, yes or no? Now, see. This portfolio can have a return or not? No. That is 2 in A, 0.5 in B, minus 1.5 in what? C. For example, A gives you a return of 10%. What is the return of A? 10%. B gives a return of 12%. And C gives a return of what? Say 8%. Are you following what I'm saying? In that case, now let us have a small discussion. Now tell me our proportions. Please tell me a proportion. What is the proportion of A, B and C? A, B and then what? C. The proportion is what here? 2.5 and then minus 1.5. Now, expected return. Say the expected return of A is say 10%. Expected return of B is say 15%. C is say 9%. Everybody follow what I am saying? I can find out these three with the same expected return. Are you follow what I am saying? Now, tell me in that case, what is weighted return? 2 in 1 gives how much percent? 20%. This is what? 7.5. It becomes what? Minus 13.5. Right or not? No. If I add it, 27.5 minus how much it is here? 14.5. This is a, you're going to be sorry, 14. This is called as what? Return of portfolio. Yes or no? Now, this 14% return I am earning for how much risk? Zero risk. It can be called as risk-free return. Yes or no? If this return is more than the RF in bond market, then this becomes efficiency frontier. Are you following what I am saying? The entire frontier what? Changed. The CML, nothing will work here. This becomes what? Efficiency frontier. Are you following what I am saying? So, investor will be watching all this. They say, for zero risk, I am getting what? 14% return through this portfolio rather than what? Risk-free asset. Now, what the APT says is that the demand for this portfolio increases. Yes or no? Correct. Demand for the portfolio increases. Now, more A will be purchased, more B will be purchased, and more C will be sold. Yes or no? And risk-free asset will not be having what? Any demand because this is giving a better return. That's what I am saying. So what the market does is the price of A begins to increase, the price of B what? Begins to increase, and the price of C what? Begins to decrease. Short selling proceeds reduces, investment cost what? Increases. Slowly the portfolio return what? Decreases. Yes or no? And the RF return also what? Decreases. Or price also what? Decreases due to what? Lack of demand. Slowly after some time equilibrium will be what? Achieved. This is because arbitrage process. Everybody are you following what I am saying? This is because what? Arbitrage pricing theory. They don't believe that market portfolio is always good. Whether market efficient, innovation, all those controversies they don't go. You have to see like this different combinations in what? Market and select the best one for investment purpose. Everybody following what I am saying? So this is regarding this particular strategy. Tell me, is borrowing better? C better? Short selling C is better. Even it's going to give me what? A better investment opportunity with a lesser risk. Everybody following what I am saying? Now, more about this is to be learned in the next problem. In this problem, only thing which I learned extra is the two ways of getting money. One is what? Borrowing money. And is what? Borrowing shares. Borrowing shares I call as what? Short position. With borrowing money, I cannot change my portfolio risk to my satisfaction. Because by borrowing money, the beta is what? Zero. In fact, borrowing increases what? Risk. It is not going to tackle my risk problem. Yes or no? But by borrowing share, I can just alter my risk to my satisfaction. I can just take a negative portion in what? Share market and have a negative beta to counter my already existing positive beta response. Yes or no? So how to negate your beta? There are two options. Find out share having a negative factor beta or what? Take a negative portion in the share market so that you can just reduce your beta. The short selling gives more option to the company for risk reduction. Respond. Yes or no? This is what has been discussed in this particular problem. About this notes has been given already in the sheet. We'll discuss it later. Everybody, are you having the clarity or not? With this, we complete the solution to this particular sum. Exam la answer only given, but now we just what? Interpret it. Tell me, should I ask any risk premium for A and B and C or not? That is risk premium for this particular portfolio or not? No. Because the portfolio risk is what? Zero. I should not ask any premium. Everybody following not? Write down. The risk premium for the portfolio should be zero. The risk premium for this portfolio should be zero. The risk premium for this portfolio should be zero because the portfolio is risk free. The risk premium for this portfolio should be zero because the portfolio is risk free. Because the portfolio is risk-free. Portfolio is risk-free. Since its beta is 0. Because the portfolio is risk-free. Since its beta is 0. Since its beta is 0. Now, don't think I am not dictating any further notes about short selling and all. I have given that. Also explained with the help of what? Security, see the beta say behavior also. All this is there in the notes. I am not writing the notes. Only numbers have been copied. Can I proceed or not? Now, we'll read the notes in another half an hour time once the other problems are completed. Everybody, can I proceed or not? Now, so with this we complete question number 26. Now, what is the moral of this problem? What is the story of this moral of the story? Yeah. I can raise money in how many ways? 2 ways. Either by what? Borrowing, or through what? Short selling. Borrowing increases financial. Increases what? It creates leverage. It creates what? Leverage. Short selling does not create what? Leverage, because the short selling gain or loss also moves along with what? Market. In fact, short selling can be used as a tool to reduce what? Risk of my portfolio. Portfolio risk can be reduced in 2 ways. What are 2 ways here? One is by identifying securities which having what? Negative factor beta to counter what? Positive factor beta, or identifying what? Securities with positive factor beta by taking what? A sell portion that to convert the beta into negative. This is going to give all the fund managers a leverage. Leverage means what? Advantage of tailoring this to a requirement. You can just take any risk you want. If you want to take what? A risk of 1 beta, further you can construct what? Portfolio with what? 1 beta based on short selling, negative factor beta and positive factor beta, as well as what? Risk creation also is possible. Everybody, are you found what I am saying? Is the APT tries to say in this particular sum. Can I proceed or not? Now, next is sum. Still, we have not answered one question. How to find out what? Risk premium for the factor, yes or no? That can be understood through the next question. Everybody, can I proceed or not? Now, in the question, 2 questions has been asked. First is what? Find out the factor, find out the risk premium for the security. Tell me KE is equal to, what's the formula? Lambda 0 plus beta 1 lambda 1 plus beta 2 lambda 2. What is lambda 0? Risk-free rate. What is beta 1 lambda 1 beta 2 lambda 2? Factor risk premium. So in this case, no risk rate is given. They are given only what? Factor risk premium. Based on that, we have found out this risk premium for the security. Can I proceed or not? Now, take the next sum. Take question number 20. Take question 27, please. Again, a pause examination problem. Okay, now. Please, let's read the question and then go for the solution. More detail about this can be discussed when the solution is over. Now, I want a confirmation. 26th question, what I discussed, everybody understood it or not? Now, take question number 27. Small questions only. Mr. X owns a portfolio with the following characteristics. Please. Security A, security B and risk-free security. Factor 1 beta for A, B is 0.5, 1.5. What the risk is going to be what? 0. And a risk-free will not move with what? Any macroeconomic factor. Yes or no? No. Factor 2 A, B is 0.8, 1.5 and risk-free is going to be 0. Expected return of A is 15%, B is 20%, C is 10%. Tell me how I calculate expected return, average return. Is something but weighted average or simple average based on probability given or not given. Is expected return of the security and risk-free asset. Now, it is assumed that the securities returns are generated by 2-factor model. In what combination one should invest in A and B that the overall portfolio is insensitive to changes in factor 2 beta, sensitive to factor 2 beta. Make like this. In what combination one should invest in A and B that the overall portfolio is insensitive to changes in factor 2 beta. That means factor 2 beta should be what? 0 is my target. B. In what combination one should invest in A, B and risk-free security so that the overall portfolio is insensitive to changes in factor 2 and a sensitivity of what? 1 to factor 1. Very interesting part is part B that gives us the answer for risk premium. Everybody follow what I am saying? So now let us understand the solution for this problem before I proceed further. Now, answer my question. Don't get too confused. Simply answer. Number 1. How many securities are there? What are two securities here? A and B. Along with that, risk-free also is there. So there are 3 securities, A, B and then what? Risk-free. For A and B, there are 2 influencing factors, 2 macroeconomic factors, namely what? Factor 1, factor 2. They have been given what? Factor betas. For risk-free security, no macroeconomic factor probably what? Affects it. So the factor beta is what? 0. The return of A is 15, return of B is what? 20, and the risk-free security is going to be how much percent? 10%. Everybody accept or not? No. Let's answer question by question. First question is, I want to construct a portfolio. I want to construct what? Portfolio. With only, question here, I want to construct a portfolio. Answer with only A and B that has a factor 2 beta 0. Any factor 1 beta they are worried about it. They want to have what? Portfolio consisting of what? A and B in such a proportion that the factor 2 beta should be made what? 0. What is the portfolio? The first question, yes or no? Then the next question they ask is, they want to construct a portfolio consisting of what? A, B and risk-free asset which has factor 2 betas what? 0 and factor 1 betas what? 1. Right or not? So that is going to be the second portfolio. Now, so let's answer the first question and then what? Second question. First tell me, are you able to understand the question or not? Let's start with the solution. Let us do it together. Okay? Now. So don't ask how I found out 0. The word, the overall portfolio is insensitive means what? Not sensitive enough, it should not react, it should not vary. Then that means what? Beta should be 0. Did you understand the wordings or not? No. Okay, let's do it together now. Question number 27. Part 1. Let's do it together. Part 1. Investment in A and B. Part 1. Investment in A and B to make factor 2 beta 0. Investment in A and B to make factor 2 beta 0. Investment in A and B to make factor 2 beta 0. To make factor 2 beta 0. Now can I start on now? Now. Let PA be proportion of A. Let PA be proportion of A and 1 minus PA proportion of B. Now if I invest 40% in A, B should be how much percent? 60%. Understandable. Only A and B, yes or no? Let PA be proportion of A and 1 minus PA be proportion of B. And 1 minus proportion of A be proportion of B. Can we start or not? Now. 0.8 into proportion of A. I want an answer. What is 0.8? What is 0.8? I am now discussing about factor 2 beta, yes or no? So A is having a factor 2 beta of 0.8 and B is having factor beta how much here? 1.4. Yes or no? The weighted beta should be what? 0. I want portfolio beta to be 0. Right or not? Now, continue writing. 0.8 into proportion of A. 0.8 into proportion of A. For A, factor 2 beta is 0.8. And what is for B, factor 2 beta? 1.4. 1.4 into 1 minus proportion of A. 0.8 into proportion of A. And 1.4 into 1 minus proportion of A. Answer should be equal to what? 0. Why? Because the portfolio should be having what? 0 factor 2 beta. Everybody understanding it or not? Now, please simplify it. 0.8 proportion of A plus 1.4 minus 1.4 proportion of A is equal to 0. 0.8 proportion of A plus 1.4 minus 1.4 proportion of A is equal to what? 0. Rearrange. 1.4 minus 0.6 proportion of A is equal to 0. 1.4 minus 0.6 proportion of A is equal to 0. Are you understanding, reading or not? Simplifying it. Now, proportion of A is equal to 1.5 by 1.4 by 0.6. Proportion of A is equal to 1.4 by 0.6. Is equal to how much here? 2.33. Is equal to 2.33. Stop writing and tell me, I have 1 rupee. Suppose I have how much rupees here? 1 rupee. How much invest in A in stock market? 2.33. Where do you go for 1.33 money? Printer. Borrower. Short sell. And B is not a risk-free, it is what? A security, yes or no? Proportion of B is equal to what? 1 minus 2.33. Proportion of B is equal to 1 minus 2.33 is equal to what? Minus 1.33. Proportion of B is 1 minus 2.33 is equal to minus 1.33. Now tell me the strategy. What I should do? Have 1 rupee will, short sell 1.33 of what? B, invest 2.33 in what? A. If I do like this, the portfolio, that is as a factor 2 beta will be what? 0 for this portfolio. Are you following what I am saying? By short selling B, I create a negative beta situation inside the portfolio. Right or not? In that case, a factor 2 beta can become what? 0. Respond yes or no? Now, write on. For factor 2 beta to be 0, for factor 2 beta to be 0, for factor 2 beta to be 0, construct a portfolio. For factor 2 beta to be 0, construct a portfolio by selling, construct a portfolio by selling 133% of the wealth, by selling 133% of the wealth of security C, by selling security B, by selling 133% of the wealth of security B, and investing 233% in security A, and investing 233% in security A, and investing 233% in security A. Your alternative here, instead of borrowing 133% of my wealth, I want short sell 133% of my wealth in what? Security B, and invest what? 233. Yes or no? Only advantage in short selling is it may just want put a break on the risk by having a negative beta inside my portfolio. Everybody yes or no? This accomplishes what beta? Factor 2 beta as 0. Now respond yes or no? Now let me go to the next part. Now this I will do it and then give you time to copy, participate. Now, I want to have a portfolio. Everybody answer. I want to have a portfolio comprising of what? A, B, and risk-free asset. This portfolio, I have a target. The target is for this portfolio, factor 1 beta should be what? 1, and factor 2 beta should be what? 0. Am I right in interpreting? That is, overall portfolio is insensitive to change in what? Factor 2, and has a sensitivity of what? 1. That means I want to make a portfolio where that portfolio does not react to factor 2. Does not react to what? Factor 2. Whatever may happen to the factor, the return remains what? Unchanged. But that react exactly same as what? Factor 1 is what I have to consider. Yes or no? How to consider the portfolio discuss. From there we will take further the concept of risk premium in APT. Everybody can I proceed or not? Now, look at this. Let PA be what? Proportion of A, and PB be what? Proportion of B. And the PRF should be what? Proportion of risk-free asset. That can be understandable, right or not? Now, see, I want to have a portfolio beta. Factor 1 beta as well as what? Factor 2 beta. Now, tell me, factor 1. Look at the workbook and tell me, what is A factor 1 beta? 0.5 into proportion of A plus what? 1.5 into proportion of B plus 0 into proportion of RF is going to be what? 0. So the portfolio factor 1 beta is 0.5 into proportion of A plus what? 1.5 into proportion of B. You see factor 1 beta for this particular portfolio, yes or no? That should be equated to what? 1. Yes or no? Now, tell me the second equation. 0.8 into proportion of A plus 1.4 into proportion of B should be equal to what? 0. Then solve for the two equation. I'll be getting what? Proportion of A and proportion of B. 1 minus proportion of A, proportion of B gives what? Proportion of the risk-free asset. Everybody, are you all following the discussion or not? Yes or no? Okay, now. 0.5 into proportion of A plus what? 1.5 into proportion of B. He is going to give me what? Beta of the portfolio. What beta? Factor 1 beta. I want it to be what? 1. Who said? Question said. Can I say it? Now, please can you tell me the second equation? Everybody should hear the voice. Tell me the second equation. 0.8 into proportion of A plus 1.4 into proportion of B is equal to 0. Respond, yes or no? There are two linear equations. Have to solve two variables, PA, PB, yes or no? If I solve, I can get P and PB or not? Yes. Solving, I get proportion of A is minus 2.8 and proportion is how much here? 1.6. Ennappa, right or not? Now, that means proportion of risk-free asset is 1 minus 2.8 minus 1.6. Enna purinjada? Now, if you want, I'll write it here. So what is proportion of A? Minus 2.8. B is what? 1.6. Now, proportion to be invested in risk-free asset is equal to 1 minus proportion of A minus proportion of B. Accept or not? Now, in that 1 minus what proportion of A? Minus 2.8 minus 1.6 is equal to 1 plus 2.8 minus 1.6 is equal to how much? 2. Number 8 is 2.2. So it is going to be the proportion of risk-free asset is equal to how much here? 2.2. Very simple. 1 rupee, I have money in my pocket. Own wealth. What is own wealth there? 1 rupee. With 1 rupee, I am going to invest 2.2 rupees in what? Risk-free asset and 1.6 in what? B. That means I invest 3.8 rupees. I invest 3.8 rupees in the risk-free asset and then what? Security B. But I have only how much rupees here? 1 rupee. Where to go for the balance 2.8? Short sell A. Respond yes or no? That is, short sell A raised 2.8 rupees. Already my wealth is what? 1 rupee. Totally what is the wealth in my hand? 3.8. What will be the 3.8? Invest in what? Risk-free asset. Also invest in what? B. Then I will be getting what? A portfolio. That portfolio is having what? 0 risk to factor 2 and 1 risk to what? Factor 1. Respond. Are you following what I am saying? Yes or no? So this is regarding this particular answer. You can copy up to this. Then we can just go for the understanding of how this is important. Exam question over. But this is a very interesting part in APAT. We link it to the APAT risk premium in the next stage. Everybody following up? Now, please copy the solution. This first part over. I don't part 2. Heading copied, huh? No, heading, investment in A, B and RF to make factor 1 beta as 1 and factor 2 beta as 0. Over or not? Can I proceed? No. Finished, huh? By heart, write it. Can I proceed? No. Stop talking. Those who are not copy, raise your hand. Finish copying, please. Shh. Can I proceed? Write down. Invest 220% of wealth in risk-free asset. Invest 220% of wealth in risk-free asset. We are having 2.2 no? Invest 220% of wealth in risk-free asset. 160% of wealth. 160% of wealth in what? Security B. Invest 220% of asset in risk-free asset. 160% of wealth in security B. By short selling. By short selling how much? 280% of wealth in security A. By short selling 280% of wealth in security A. By short selling 280% of wealth in security A. A take a sell portion, B and RF take what? Buy portion in the market to construct this particular portfolio. Answer is over. Can I proceed with the next discussion or not? No. Please, all of you help me out. This is a portfolio, right or not? In this portfolio, what is a return? Weighted average return. What the risk here? Weighted average beta. When you calculate the risk for this portfolio, factor 1 beta should be 1 and factor 2 beta should be what? 0. Now let us write the return and risk of the portfolio and then go for a final conclusion discussion which nails everything about the APT, then be having a summary of it. Can I proceed or not? Now, please, all of you participate. Now, I want to find out return of a portfolio. No need to copy. Please participate. Tell me what is the return of a portfolio? Security, proportion, return, weighted return. This is going to be the return of the portfolio, right or not? Tell me, what are securities here? A, B, RF. A, how much I invest? Minus 2.8. What is B investment? 1.6. C is what? What the total here? 1. Are you following or not? No. Return of security A, look at the workbook and tell me what is the expected return of A. Tell me how much it is. 15%. 15%. B. 20%. RF. Am I right or not? Now, minus 2.8 into 15 gives how much it is? So look, what is the number? Minus 42 la. Minus 42. Please. Shh. Minus 42%. 1.20 gives you what? So what is the 2.10 gives you how much? 22%. What is the return here? 54 gives how much it is here? RP is equal to 12%. The return of portfolio is equal to 12%. Accepted or not? Please. This portfolio should be having a risk or not? We know the risk. For the macroeconomic factor 1, the risk is what? 1. For the factor 2, the risk is what? 0. We can even calculate and check it before you go for the next. And calculate risk or not? Tell me what are the columns here? Security, proportion, beta 1, weighted beta 1, beta 2, weighted beta 2. Everybody, are you following or not? Now, please tell me the what are the securities? A, B, R. What is the proportion? Minus 2.8, 1.6, 2.2. The total is what? 1. What is beta 1? Solely, look at the word. What is beta 1 of? Say A. Point. What is B beta 1? Point. Here, 0.5 and then what? 1.5. Enna correct? Tadavadiya number 1.5. What is beta? 0. Yes or no? What is weighted beta? Minus 2.8 into 0.5 is what? Minus 1.4. 1.5 into 1.6. Tell me the number. 2.4. This is what? 0. What is beta beta 1? 1. Beta 2, tell me. What is beta 2? 0.8, 1.4. Understood or not? No. It is 0.8 and then what? 1 point? It is what? 0. Tell me the number. 0.8 into 0.5 gives you 0.4. 1.4 into 1.6. Number, yeah. Sorry. Minus, yes. Understood. Minus 2 point, now. Shh. Can I stop the class? See, when I am doing, why you are talking here? And I am very annoyed because I am not able to read the question number after solving the question. Right? Now, if you create confusion, I will not able to hear numbers and I am getting confused. Can I say it? Now, solupa. Minus 2.8 into 0.8. What is the number? Minus 2. Okay. 1.6 into 1.4. 2.24. This is what? 0. What is the item? 0. Please, listen here. I have a portfolio in the market. This is really there. That is a portfolio in the market which give me how much percent return? 12% return, which is having no risk to factor 2 and a risk of what? 1 to factor 1. Yes or no? Now, see, let us go back to the original beta. Let's go back to what? Original beta. Please. Beta of security A is 2 times. Let us take beta of what? Security A is what? 2 times. What is the meaning of that? When market portfolio changes by 1%, the security changes by 1% is 2%. Yes or no? In a clarity, so the beta of 2 times means when the market portfolio beta is equal to what? 2 times means when the market portfolio changes by 1%, the security changes by 1% is 2%. It is the meaning of 2 times beta. Yes or no? Okay. Now, what is beta of market? What is the beta of market portfolio? 1. When market portfolio changes by 1%, the market portfolio changes by 1%. Now, very simple. Let's take, I am the market, you are the security. Okay. Raju Gopal, student. Okay. Now, please see, if Raju Gopal understand 1%, student can understand 2%. Leverage that. I explain more. Right on order now. Example. Okay. So if I understand 1%, you understand what? 2%. Your beta is 2 times for me. Yes or no? If I get confused 1%, you get confused what? 2%. Right on order. Both they risk. That means beta of Raju Gopal with student is 2 times. If I understand 1%, I understand 1%. If I don't understand 1%, I don't understand what? 1%. Beta of Rajagopal with Rajagopal is what? 1. Yes or no? What I am saying? How 1 behaves, 1 family is going to be what? 1 beta only. Everybody, yes or no? Now, correlation is perfect. Yeah, right or not? In that case, beta of market portfolio is 1. What beta market portfolio is what? 1. Market portfolio beta, I say beta M is equal to what? 1. It gives a return called as what? RM. Suppose RM is 14%. What is RM here? 14%. I say that for a beta of 1, I get how much return? 14%. And there is also a risk-free asset. The beta of RF is what? 0. And the RF is going to be what? 10%. What I say is, for a beta of 0, I want 10%. For a beta of what? 1, I will get how much percent? 14%. So the risk premium is what? 4%. For 1 beta, yes or no? The security is having what? 2 beta, but has 8% risk premium. Everybody, are you following what I am saying? That's why we ask the risk premium. So, how to ask risk premium is, construct a portfolio with a 1 beta. Portfolio is what? 1 beta. That return is the return required for 1 beta minus risk based gives you what? Risk premium for the 1 beta portfolio, and for any other beta portfolio, the difference is what? The beta times the risk premium. Yes or no? That means to calculate this 4% risk premium, how I calculated? I took a portfolio with a beta of 1 and compared with what? Portfolio of what? Beta of 0, reduce it to get a risk premium of 4%. Respond, yes or no? This was possible earlier because x-axis is market, y-axis is what? Security. I had a written for the market also. Are you follow what I'm saying? Now, here we come back to the APT. APT, the KE is equal to lambda 0 plus what? Beta 1 lambda 1, beta 2 lambda 2, etc. Now, in that case, beta 1, beta 2, beta 3, factor beta, we know how to calculate it. We draw number of regression line. One is x-axis GDP, y-axis what? Security return. Find out the slope, that is beta 1. Yes or no? Then x-axis inflation, y-axis is what? Security. Find out what? The beta 2 and so on. We know how to calculate factor beta for each and every factor. Yes or no? But at that time, I said how to find out what? Risk premium for GDP. For 1% GDP risk, how much should I ask as premium? I should ask no. Yes or no? Because for GDP, how much premium should I ask? I cannot find out because I don't know the equilibrium return to ask for premium. Right or not? Now, come to this particular sum. Now, in this sum, understand that beta 1 is GDP. What is beta 1 is what? GDP. Factor 1 is GDP and factor 2 is what? Interest. Let's have it. Factor 2 is what? Interest. See, I have constructed a portfolio. I have constructed what? Portfolio which is having 1 beta to GDP and 0 beta to what? Interest. That means the risk premium this portfolio gives is only for what? GDP and not for interest. Yes or no? That means this portfolio return how much percentage? 12%. Now, see, I have a portfolio which is having a beta as well as what? Return. This portfolio is having beta 1 as what? 1 and beta 2 as what? 0 and it gives me return how much percentage? 12%. This is one portfolio. So no. Now, there's another asset called as what? Risk-free asset for which beta 1 is what? 0 and beta 2 is what? 0. Is how much percentage? 10%. That means 2% is what? Risk premium for beta 1 other lambda 1. Are you following what I'm saying? Everybody, yes or no? So now I have discovered the lambda 1 or not. How I found out? Very simple. I constructed a portfolio. I constructed what? Portfolio. What is a portfolio? That is a portfolio which is insensitive to all the other factors. Insensitive to what? All the other factors and having exactly one sensitivity to what? The factor for which I want to find out what? Risk premium. That we compare with what? A riskless portfolio. The difference is the premium. I should ask for what? Factor 1. Respond. Are you following what I am saying? Now, tell me the example. Suppose there are 4 macroeconomic factors. GDP, inflation, interest rate, exchange rate. Can I have 4 or not? No. I want to find out risk premium for exchange rate. Risk premium for what? Exchange rate. What I should do? I should construct a portfolio. I should construct what? Portfolio which will be having beta of 0 to the inflation, GDP, interest rate and a beta of 1 for what? Exchange rate. I can construct such portfolio very easily by using short sell, risk-free, etc. Any risk can be constructed using what? All this combination. So no. So construct the portfolio which is having 0 beta to what? Inflation, 0 beta to interest rate, 0 beta to what? GDP and 1 beta to what? Exchange rate. This one portfolio in my hand. Yes or no? Have another portfolio which have what? 0 beta to everything. Yes or no? That portfolio return, this portfolio right what? Reduce it. The difference is what? Risk premium. I should ask for what? The exchange risk. Are you following what I am saying? Now, in this, I just loosely use the word what? Risk-free asset. Usually what? Risk-free asset. Because risk-free asset is always having what? Beta to all the macroeconomic factors. This need not be the risk-free asset. It can even be what? Risk-free portfolio which I considered in the earlier sum. Yes or no? This too can be a portfolio with what? A, B, etc. Combination of what? Short sell, etc. We have beta as what? 0. In the last problem, I had beta 0 for both 1 as well as what? Factor 2. Yes or no? Now, what APT says is, this is not practicable. What they say is, construct a portfolio. Different portfolios are possible. Construct a portfolio which gives 0 factor beta for all the factors. Find out a return. Find out what? A return. Number 1. Construct another portfolio which has what? 1 factor to the specific economic factor and then 0 to what? All the things. Take that return. This return, that return may be what? Difference. Difference is called as what? The factor risk premium. Yes or no? But what it says is, these 2 portfolios should be the best in their own category. I can have a government of India bond with as what 0 for both and giving a 8% return. Possible? I can even have a market security with short sell AB investment which may give me what 0 beta. It may give you what 10% return. In that case, the risk-free rate which I take should not be 8. What should I take is what 10. That is the best in that particular category. Yes or no? There can be so many portfolio which can have beta of what? 1 to factor 1 and beta 0 to what? Factor 2. So many combination portfolio may be possible in the market with so many shares or not. But there exists only one portfolio that gives you what? The highest return for that particular combination. Yes or no? That should be taken as what? Representative for the factor 1. The reference is a factor risk premium. Innappa right or not? What people say is how to find out that one or two I can construct. I cannot keep on what? Constructing so many portfolios like that. It becomes difficult to find out what? Efficiency, frontier itself. So this logic is true. This logic is what? Very perfect. Everything what they said is what? Perfect. Only thing is still they have not understood a practical way of what implementing this particular APT theory. Are you following what I'm saying? But what people now do is CAPM they use, but with their limited knowledge, some of the stocks they are following or not. If that stock gives a portfolio more than what a government of India bond, that they'll be taking as a risk rate. Yes or no? There can be some stocks which can give me what a good return more than what CAPM return. They can be taken as what the equilibrium return. From there they can start asking what the KE and so on. It is now partially applied. One cannot say this is a correct KE for what any stock because we cannot find out best security for different factor combinations. That's a practical difficulty of what arbitrage pricing theory. This part I can say all this not discussed in what study material, but from whichever source they would have taken from, I don't know the source, but in that source, the intention of the problem should have been to find out what? The risk premium for factor 1. You know what I'm saying? So, the problem is only partially lifted and what? Asked, but this is a real intent behind what? The entire question. Everybody following or not? Now, one final discussion. Now, let's conclude. Tell me, what is KE? What is KE? RF plus beta into RM minus RF. As per what theory? As per what? CAPM. But as per arbitrage pricing theory, they said you should not have one beta, you should be having what? Multiple beta, because different factors affect the security differently. Don't ask only one premium, have what? A factor risk premium. So the formula K is equal to what? Lambda 0 plus beta 1 lambda 1 plus beta 2 lambda 2 plus beta 3 lambda 3 and so on. Respond yes or no? No. How to find out beta 1, beta 2, beta 3, etc. Rigorous, every factor with what? Security return, GDP and share, inflation and share, interest and share. We can find out the slope of all those data or not, all the statistics only data or not. So you can find out beta 1, beta 2, beta 3, etc. etc. Not difficult in finding out the factor beta. Yes or no? No. The main problem in say what I can say APT is how to find out what? Factor risk premium. For that they gave an option. What is the solution here? What you do is take a portfolio which is insensitive to all the macroeconomic factors. All more that is going to be having what? Beta 0 for all factor beta. Factor 1 beta 0, factor 2 beta 1 0 and so on. Example is the last question number 26. Yes or no? No. That portfolio gives a return or not? That return is a risk-free return. Is what return here? Risk-free return having what? 0 to all the macroeconomic factors. Yes or no? No. Take another portfolio. Suppose I want to find a premium for GDP. I want to find a premium for what? GDP. That means suppose 4 factors are that GDP, interest, inflation, exchange rate. I want to find a premium for what? GDP. Construct a portfolio which is having 1 beta for what? GDP and 0 beta for what? Remaining 3. That means that return of the portfolio will be more than what? The return of what? Portfolio having what? 0 beta for all the 3. Why the extra return? The extra return is for what? The GDP risk. That will be a risk premium for the GDP. Yes or no? Then we can call this out what? Lambda 1. Like the finder for lambda 2, etc. etc. And then construct a portfolio. Ask for the required return is what APD tries to say. Yes or no? Here the problem for the implementation is I can have 100 portfolios. And how many? 100 portfolios. It has 0 to 1. GDP, 1 to GDP and 0 to what? Remaining 3. And short selling, loan combination, so many combinations are possible or not. Out of the 100, the best can be what? Selected. That may even really exist 1,000 portfolios also. How to know which is the best return? Because in CAPM and all, they somehow accepted that market is best. You cannot beat what? Market. It may be best, may not be best. We accept as best. Manmohan Singh may be best, May not be best. Somebody is there, yes or no? For us to call us what? A prime minister, rather than have a anarchy. Right? What I am saying? In that case, market portfolio may be best, may not be best. Separate controversy in every market hypothesis, but somehow they accepted it and start asking for what? Return. Here they open the Pandora box and said, everything you have to check what? One by one. Now, who can check? That is the main problem in this APT. But what happens is, investors or tracking sectors who are managing what? Few securities, within that can try to beat what? CAPM and identify the best securities using what? APT is what one can understand. Everybody, are you following or not? With this, we have completed all the concepts relating to what? Arbitrage pricing. Don't escape. Just a minute. Now, one more problem is pending in this APT. Okay, now. I know you have a law class, but before that, that problem can be done. That is not any great sum, same type of problem only repeated, one RTP sum. But before I leave you, let us read the notes what has been given to understand the full scheme of APT. It's like a summary only you are going to have and then complete this APT. Okay. Have you all brought that particular sheet? Okay. You may not be able to see this in the slide, very dull, but you should be able to see in the sheet, right or not? Now, please. See, instead of I summarizing, I am summarizing through notes. You have a confidence that everything discussed has been given here. Are you following what I am saying? Now, and every point should be understood. Around 17 points are given this notes regarding the APT. I'll just quickly do it another 3 minutes, please. Shh. Those who want to leave, now itself leave, don't disturb after I start. Can I start or not? Quick, run fast. Run, please. Okay. I will manage. You don't get cooked up. Can I proceed now, please? Now, please. Just 3 minutes, not more than that. Concentrate. This will give you the full grip over the APT, what has been discussed. Please. Shh. Can I start up? Now. Risk of a security is nothing but what? Variability in security return. Right or not? B is equal to beta square sigma m square plus what? Sigma EI square. Please. Security return varies due to 2 reasons. Stop talking, please. I want full concentration. Can I proceed? I am doing it for you. Can I proceed? Now. Security varies due to how many reasons? 2 reasons. Now tell me what are 2 reasons here? The system varies, so the return also varies. The variance may be also due to what? Unsystematic reasons. Arises through macroeconomic factors and is measured through beta and market portfolio variance. Company specific and random measured through what? Variance of standard error. These are all from the Sharpe single index model. Right or not? Next. CAPM states that unsystematic risk can be diversified away and hence an investor should require premium only for the systematic risk. Both CAPM and Sharpe single index model uses market index, that is market portfolio, as a proxy for measuring the systematic risk. For example, if beta of a security is 2 times, it means when the market return changes by 1%, system changes by 1%, the security return changes by how much percent? 2%. So when the system changes by 1%, how we measure the system here? Market portfolio variance. Everybody following or not? Now, next. APT says that the real source of systematic risk is not the change in market index. In fact, it is what made the market index change. That is what? Macroeconomic factors. Tell me the systematic risk comes from the market portfolio change. What makes the market portfolio change? What makes the market move up and down? The inflation, the GDP, etc., etc. Right or not? Now, next. Some examples of risk due to macroeconomic factors are business cycle risk, measured in what? GDP change, interest rate risk, inflation, energy risk, exchange risk, etc. Okay. Now, when we say beta of a when we say beta of a security to market index is 2 times, we presume that security return has beta of 2 times to all the macroeconomic factors affecting the market index. Yes or no? When I say beta 2 times, whether the market changes due to inflation or change due to what? GDP, for any change, the security is how much percentage? 2%. This assumption is wrong because all the macroeconomic factors need not affect the company in the same way. For example, there are 2 macroeconomic factors, say GDP and interest rates, and there are 2 companies, airline and then power utility provider. Airline company business heavily depends on what? GDP growth, hence more sensitive to the macroeconomic factor, On the other hand, utility provider is generally not that much affected by business cycle, and hence their cash flows are stable. Due to their stable cash flows, their present value is greatly affected by interest rate change. Thus, it is proved that beta of the 2 securities in relation to macroeconomic factors is different, even though they may have the same regressed beta in relation to the market index. Everybody following or not? No. In APT, we regress the security return to each macroeconomic factor and find out the beta for each such factor. This is popularly called as what? Factor beta. I regress GDP and security, inflation, security, and so on to find out what? Factor beta. Next, in CAPM, the required return is K is equal to what? RM plus beta into RM minus RM. In APT is calculated as follows. K is equal to lambda 0 means what? Risk-free return plus beta 1, lambda 1, beta 2, lambda 2 and so on. What is beta 1, beta 2? Factor beta. What is lambda 1, lambda 2? Factor risk premium. Can I proceed or not? No. Please. Shh. How to find out the factor risk premium? That's what we discussed just now. It or not? No. This is a difficult exercise. We should identify a portfolio which has beta of 1 with respect to a factor 1 and beta 0 with respect to what? Other factors. This portfolio will give us a return from which we have to deduct what? Risk-free rate. We get a factor 1 risk premium. Similarly, we can find out risk premium for other macroeconomic factors also. Example done in the last question. Innappa, right or not? No. Next. A person can construct portfolio with target beta 1 for a particular factor and target beta 0 for other factors with the help of combination of what combination? Invest in market securities with positive or negative factor beta. I can index say negative beta either through what? Security or through what? Position. Invest in security with either positive or negative factor beta, risk-free asset and short selling. This can be seen from the solution to problem number 27 in the workbook. Everybody following or not? Now, next. Concept of short selling. I explained that now. You can understand that I given everything here. Yes or no? So, short selling concept has been discussed. Now, last point number 14. How short selling person can create negative beta situation. Point number 14. In problem 26, the factor 1 beta say GDP for security C is how many times? 2 times. This means when GDP increases by 1%, the security increases by what percent? 2%. For a person who has invested in the security, he will be happy when GDP increases and vice versa. However, for a person who has short sold the shares and expected to buy the share later, when GDP increases, he suffers a loss because of the purchase of security be at a higher price and vice versa. So the investor of the security C beta, he is having a negative beta situation. Everybody following or not? No. Last but 2 points. Short selling is nothing but borrowing shares, selling it and raising money to make investment. The alternative to what? Borrowing money directly at risk-free rate. Borrowing money to make investment increases risk due to financial leverage. However, financing using short selling in fact reduces risk as it creates a negative beta in the portfolio. Using short selling risk-free assets, securities with negative factor beta and securities with what? Factor, say a positive factor beta, we can construct portfolio called zero risk portfolios. In such portfolio gives higher return than the risk-free asset. Then the CML ceases to be the efficiency frontier. Is what is the arbitrage pricing theory. Everybody, yes or no? 2 more sums we'll do in the next class. Start with the leasing and capital budgeting, very regularly last area in the examination.
Thank you friends. OMSAI Bhojanapalli.